to the 2021A bond issue. So Ed.
Good morning. You have in your package an amendment to the standard single family resolution that was approved at the November board meeting. The amendment increases the bond issuance authorization to up to 270 million of bonds from the original authorization of up to 150 million of bonds. Since the board approved the resolution in November, prepayments have continued at an elevated rate and interest rates have remained historically low. Increasing the amount of bonds will allow the authority to refund additional outstanding bonds to generate savings on debt service and preserve volume cap, while still providing a source of bond proceeds to continue to fund single-family home ownership loan purchases. The bond issue is still expected to close by the end of February, but will depend upon market conditions. As stated in November, Citigroup will be the book running senior manager for this bond issue. Does anyone have any questions?
Go ahead.
This is Kathy. It was unclear to me what it was that happened between November and now that necessitated the increase. And I wasn't quite sure how an increase in, and I'm sorry if this is a silly question because the increase in prepayments requires an increase in bond issuance.
Yeah, we were expecting prepayments to slow down. They haven't. So what happens is, as prepayments come in, prepayments on the underlying loans, the asset and the assets, which are the loans, prepay. So we have cash on hand. The liabilities backing those, what was used to fund those mortgages, the bonds, are still outstanding. So we have an asset liability mismatch. So what's happening is we've got money that came from prepayments invested in the STIF, which is only a few, less than 10 basis points, paying bonds that are, 300 basis points. So we've got a big mismatch. So the same on debt service will use those prepayment funds to call bonds, issue, in this case, some COBs or some other type of bonds, and that'll preserve also preserve the volume cap and lower our debt service costs.
Got it. Okay, thank you.
Welcome.
So to follow up on that question, so really the upsize of the bond deal isn't really what you're going to do is the marginal increase is going to be used to refund outstanding long-term debt rather than more issuance for loans for first-time home buyers.
Correct.
Because we're under production on first-time home buyer origination. Yeah. We're under budget.
Any other questions? Can I have a motion?
I'll make a motion.
Second.
I'll second.
Any more discussion? We'll go to a roll call.
Jerry Abrahams.
Aye.
Tim Hodges.
Aye.
Kathy McKinnon.
Aye.
Franklin Perry.
Aye.
Sarah Sanders.
Aye.
And do we have George Perez?
Yes, I'm here and I abstain because I have no idea what we're voting on. So I came in late.
Okay. And Gwendolyn Thames.
Aye.
Okay.
The next item is the allocation of state carry forward by Hadzim.
Yes. So last December, the State Bond Commission awarded CHFA $105,962,174 of unused 2020 private activity bond volume cap. To preserve the award, the Internal Revenue Code requires us to file a carry forward application by February 15. We are recommending the approval to carry forward 100 million for multifamily and the rest for single family. In addition, on December 20th, the Census Bureau announced the state experienced a drop in population by 8,281 residents. The drop impacted CHFA 2021 tax exempt volume cap allocation and the 9% low income housing tax credit calculation. And the 2021 lending plan has been updated accordingly. I'll be happy to answer any questions the committee may have.
Are there any
I
questions?
had one. Yeah, I had one question. Now that the 4% credit has been fixed, has that been factored in at all into the lending plan? It seems like we'll be able to generate quite a bit more equity.
Yes, yes. But then we're still trying to decipher how much additional raise we can get from the community. So we have been receiving requests from projects that are working towards initial closing. They are seeking and updating their budget to account for the additional raise.
I have a question. The population drop, is that for what year again?
For what year,
Based on the
Commissioner?
census? Yeah, you
Yes.
said that it's Census Bureau? Yeah.
Yep. It's
For what year?
through
2020,
June 2020.
June 2020?
Yeah.
So that's before some of the people who, quote unquote, moved from New York to Connecticut would have been reflected.
I would think so, but the way, if I'm not mistaken, you know, the number came from the American Community Survey.
Which doesn't mean anything to me.
Can you repeat that?
Which, that's nice, but it doesn't mean anything to me. I don't know if they go house to house and count people's, or do they do a statistical analysis or what?
I think
Which is
it's
not important.
the latter.
It's not important. I mean, my question was that as of what date, and you gave it to me?
Yes. Okay. Thank you.
Yeah. Because it's contrary to what you read in the paper, you know, that
Right.
you know, that's all.
Definitely. I'm hoping our population will increase.
Well, I think what may happen is we don't lose as many people, because there was another report that came out from the moving company saying that there's still more people moving out, you know, unfortunately.
Retirees.
Yeah. All right.
Any more questions? May I have a motion?
I move it. It's George.
Second?
I'll second.
Any more discussion? Let's take a roll call.
Well, you know, I just saw a quick note from Cindy's suggestion. She's with the realtors, so maybe she has some input on the people moving out or moving in, because I had the same question George had, which was all we've heard is how many people are moving into the state. The idea that we would have a population decrease seems odd, but I understand if it was June, maybe the numbers aren't reflected. But Cindy, maybe you have some input on that.
Yeah, no, and I could see if there's other numbers, but we have a lot of out-migration in Connecticut still. So we have a lot of people moving in, but a lot of the people who are leaving those properties are actually leaving the state of Connecticut.
Thank you.
Are they retirees going to Florida kind of a thing? Given the
I could find I could get as much information as you'd like on where they're going, but the good thing is a lot of people are coming back because of the pandemic. They miss their families, or they're saying we might be safer, or our schools are open. So I think there's a lot of people coming back. They're coming home to Connecticut, even if they left earlier. So we hope that trend continues as well.
But Sarah, it's not all retirees leaving Connecticut either.
Yeah.
Which is the point I think you're trying to make. The point you're trying to make it, I think, not
Sure,
to
I
speak for
know.
you.
Yeah.
Is that the majority leaving are retirees?
Just to add, this is Glenn Thames, because DCD has been tracking this data a lot, and it's the hard nut to crack at this point is the net gain, right? Because you have out migration and you have, you know, in migration, but again, what is that net gain, right? That's really the number where you see population growth, and that's not yet as clear.
Unfortunately, too, we had about 7,000 people die from coronavirus. So I don't know if that factors into that.
That is true.
Any
But
other
so that time, we
discussion?
only had a couple thousand, not that that's a small number.
Yeah,
It's
true.
one is one
It's
too
true.
many.
That's true as of June.
Yeah.
Any other discussions? Interesting topic. Amy?
Jerry Abrahams,
Aye.
Tim Hodges,
Aye.
Kathy McKinnon,
Aye.
George Perez,
Yes.
Franklin Perry,
Aye.
Sarah Sanders,
Aye.
and Gwendolyn Thames.
Yes.
Okay, unanimous.
The next item is,
Okay.
it was added to the agenda, a revised agenda that came out, resolution regarding the external auditor for CHFA. I'll turn it to Hazim.
Yes. So late last year, Bloom Shapiro joined Clifton Lawson Allen, and the merger became effective January 1 of this year. While the name is different, the engagement team remains the same. Pursuant to our act and procedures, we would like to ratify and seek approval from the board to appoint Clifton Lawson Allen as our new external auditor for a term not to exceed Bloom Shapiro's existing engagement. I'll be happy to answer any questions from the committee.
I have a
One question I had was, don't we have a contract? Do we need to revise a contract, or is it
Yes,
just?
we do need to revise the contract too, but we need approval before we can revise the contract.
Yes.
I have a question. I can't find my hand today in my Zoom. So does this doesn't extend the period, or does it?
It does not extend the period.
Right, because you know how we only keep auditors for so many years, right?
Correct. So this is the second year. So the board approved the engagement back in 2019 for 3 years. So this is the second year. So next year will be the last year of the engagement.
Okay, I just want to make sure that I understood what I was voting on. Thank you.
Any other questions? I have a motion.
Moved. It's Tim Hodges.
Second.
Now
Second, Kathy.
You. Any further discussion? We'll take a roll call.
Jerry Abrahams,
Aye.
Tim Hodges,
Aye.
Kathy McKinnon,
Aye.
George Perez,
Yes.
Franklin Perry,
Yes.
Sarah Sanders,
Aye.
Gwendolyn Thames.
Yes.
It's unanimous.
Thank you. So now we get into the reports. So the first one is regarding the audit plan. Since CHFA operates on a calendar year basis every January, and as part of an auditor's due diligence, our auditor is required to present to the Finance Committee and Board the audit plan for the last business cycle. The idea is to ensure the auditor has a good understanding of our business, evaluate the risks, apply the necessary protocols, and respond to any feedback from board members. Based on the plan, the auditor believes it will be able to complete its work and issue its opinion before the April board meeting. With that, I will hand it over to Ron Nosek, who's on the call this morning, to go through the 2020 audit plan. Ron?
Okay, thank you, Hazim. As Hazim said, and I thank him for that, we did go through a merger as of effective January 1. Our audit plan had been already worked through prior to the effective date of that merger. So where we stand now, and I'm going to go through this briefly. I'm not going to go through the entire document that I believe you have access to, but we did perform preliminary field work in December. It was the week of December 7th. The audit team met subsequent to that work and deemed that there was really nothing that came out of the performance of those procedures that caused us any alarm or any reason to think we needed to modify the audit plan as it had been devised at that point in time. We'll be coming in for final field work the weeks of February 22nd and March 1st. And we've got scheduled for wrap up the week of March 15th. So there's no reason to believe we'll have any issue relative to meeting the timeline requirements that we are under here for CHFA. Relative to the audit plan itself, all but one of the areas of focus, and they start on the document that you do have on page 7. Nothing really has changed relative to area of focus. It is a pretty broad based area of risk that we've applied. We're not just focusing on certain business segments or certain account cycles or account balances. The one thing and the last thing that's added is we are going to do some extensive internal control work and compliance work over certain programs that CHFA is performing. We did have a discussion with one of the members of the committee after our meeting last January, and also subsequent to the audit itself, relative to some programs where internal controls had been changed. We did receive that information subsequent to the performance of our audit last year, and in fact, those controls weren't in place in 2019, so there really was nothing for us to test from that perspective relative to the changes in those internal controls. So we are going to take a hard look at those programs, and in particular the modifications that came out of the changes relative to those controls. Typically in the past, we take a rather substantive approach to the audit engagement, meaning our reliance on internal controls is not all that significant. We do gain an understanding, document that understanding, and we do walkthroughs of all the significant controls, make sure that they are in place and operating as designed. In this case, we are actually going to be drawing some extensive samples and performing tests on those controls in order to gain a conclusion of low risk relative to those controls. So those sample sizes, it'd be typically to gain that level of low risk, you're in sample sizes of about 60. Internal controls are not the same as substantive. It's not an enormous number of transactions or areas that we would have to test, but nonetheless, it will be in excess of what we've done in the past. The only other change to the plan, if you will, is as I think you probably would expect, CLA, Clifton Larson Allen, they do look at things a little differently than Bloom Shapiro did. And therefore, the risk assessment that we had performed and documented back in late November, early December, relative to CHFA, we have worked through some changes with the technical folks at CLA relative to what we were planning to do and what we are going to do in the end. Generally, all that change really reflects is just the sample sizes of a lot of the stuff we're looking at. In some cases, they would allow us to reduce based on what we planned. We're not going to reduce, but in other areas, they do a little more extensive work than Bloom Shapiro did relative to the risk assessment that was performed at Bloom Shapiro. So there will be some changes, but they truly will be seamless to CHFA, other than perhaps the fact that Allison and her team may find they're pulling more evidential matter for us to look at than they have in the past in certain areas. But again, there's not going to be a change of how we operate or how we communicate with our client whatsoever. Relative to, the only other thing here is we do have some standards that are coming into implementation with the 2020 financial statements. none really of which are very impactful to CHFA's financial statement. Really, the only one is GASB 88 relative to certain disclosures related to debt. But to be honest with you, relative to the disclosures that take place at CHFA, the modification of that footnote is going to be very, very limited. So we're not projecting or anticipating any significant amount of heavy lifting relative to the implementation of these standards. So that'll wrap up what I wanted to discuss with you. My contact information, I think, is available to all of you, and I believe is actually it's in this document as well on page 3. So if any of you, clearly we're in a far different environment than we've been in the past. Welcome to my home, by the way. But anyway, if you want to reach out to me via email or phone call, please do feel free to do so.
Ron, how has your, I know we've been in COVID for some time, but how has it kind of changed the whole work of auditors? And well, we all hope that we'll get back in the office soon, but how has it adjusted your procedures, if at all?
It depended, from what we've experienced dating back to last March. It really depended on how technically advanced the systems were at our clients. So a lot of clients were quite frankly, totally paperless, and we could set up with the client secured portals to actually access information into their system, the read-only rights. And so in those instances, it went smoothly, and we were able to perform most of the work, not all of the work, off-site. There are certain things auditors have to do on site. When we do, fraud risk interviews, we out the gate, we thought we were going to have to be on site. Some clients balked at that. We did settle and actually AICPA issued some guidance relative to this, that as long as we could get in a Zoom or a Teams meeting where we were seeing someone face-to-face and performing that interview, that was going to be sufficient. But there were other clients who, I don't want to say they're in the Stone Age, but they're not really all that technically advanced from a systems perspective, and we were on site. And in that instances, we just had to work through the comfort levels of our staff. Most of them, it seemed as though the younger they were, the more willing they were to go anywhere you asked them to go. And the older you got, maybe a little more reluctant they were. But nonetheless, it worked out well. I mean, there was some, we experienced some delays, but there was nothing significant. And when it all started, we were really concerned, but that didn't play out the way we originally thought it might.
Questions for Ron?
I have one question. Can you just describe in a little more detail I know it's covered in the scope, but the work you did with respect to protecting against wire fraud, the sort of phishing wire fraud attacks that at least I know my organization has really struggled with.
Yeah, well, from the phishing perspective, we're really, we're not doing any work relative to how perhaps a fraudulent wire got to the point that it was actually being consummated. We're actually testing the actual wires themselves. So it's basically a substantive as well as a control test that we perform, and we're working on a pretty big sample relative to that here at CHFA. I think we expanded that sample in year 2 of our first 3-year contract with the organization. So we actually select, I think, 60 wire transfers that took place during the fiscal year. We perform that selection statistically, and we walk through all of the approvals relative to those wires. So we're looking at it from that perspective, that if the wire did go through the appropriate protocol as designed by the internal control, from our perspective, it followed protocol, and a very strong likelihood exists that it wasn't a fraudulent wire.
Presuming that the protocols are robust enough. You're testing just compliance with protocol, not it's a separate audit matter with respect to the robustness of the protocol.
We evaluate, we work actually relative to wire transfers. We work with our cybersecurity folks that are out of our advisory group. And they help us evaluate those controls relative to their strength or weakness as well. So, because some of this does reach outside of the realm of the typical financial statement auditor, if you will. So we do pull those folks in. They also perform the system controls work relative to the audit engagement. That's not performed by CPAs. So we are bringing in some relatively high expertise, not relatively high, some high expertise in regards to the evaluation of those controls.
Thank you.
Yep.
Any other questions? Go on to financial reports, Allison Murphy.
Good morning, all. Before you are the December financial reports. I do want to point out that what you're looking at is preliminary. We are still in the process of closing the books, and we do expect a few more adjustments over the coming weeks. On the revenue side, mortgage loan and investment interest revenue are coming in $15.4 million below budget for the year and $15.1 million lower than prior year. Revenue shortfalls continue to be in part a result of the decrease in single-family loan production. The amount of single-family first mortgages originated during the period of January through December of this year is $223 million lower compared to the same period last year. Additionally, single-family loan prepayments, as Ed was mentioning, have increased, and that is an increase of $184 million over the same period last year. The net effect of the reduction in originations and increase in prepayments is a portfolio reduction of $407 million. Also driving the reduction in revenue is a decrease in the rates on the authority's short-term investments. The average stiff rate for 2020 is about 1.7% lower than last year. On the expense side, bond interest expense is below budget by $18.3 million and is $9.4 million lower than prior year. Administrative expenses are coming in $5.7 million under budget and $1.4 million less than prior year. When you exclude salaries and bennies, or $25.3 million, current year-to-date expenses are $1.6 million lower than prior years. Are there any questions?
If there's no questions, we'll go on to the delinquency and forbearance report with John Chilson.
Good morning. For the month of December, the authority purchased 84 loans totaling $16.2 million, of which 72 loans totaling $14 million were securitized for 86% of our production. Remaining 12 loans for $2.3 million for whole loans. The average loan size was $193,000. The December month-end mortgage-backed security balance was $2.34 billion, a decrease of $18 million over the prior month, while our whole loan portfolio through November declined by 146 loans, or $21 million, a net, for a total portfolio balance at the end of the month of November for $1.5 billion. The overall delinquency rate did increase to 29 basis points to 3.65%. The carrying balance for loans in foreclosure year over year increased by $1.3 million to $43 million, while the number of loans in foreclosure increased by 9. For the month of December, the authority also funded 61 down payment assistance loans totaling $383,000 with an average balance of $63,000 per borrower. Approximately 73% of our December borrowers took advantage of the down payment assistance program. As of the end of November, with regard to forbearances, the number of whole loans in forbearance declined by 326 loans from the prior month to 469 loans involving $339,000 of monthly P&I payments on a mortgage balance of $57 million. That's approximately 3.5% of our overall portfolio. The average loan size in forbearance was $122,000. 26% of those borrowers in forbearance in November still made a monthly payment. For the month of December, we saw an additional decline of 20 loans and ended the year at 440 whole loans in forbearance. With regard to our multifamily portfolio, the authority closed one multifamily loan in December, bringing our total multifamily loans to 550 with a portfolio balance of $1.27 billion. Our permanent loan delinquencies increased by 1 to a total of 10, while the construction loan delinquencies decreased by 1 to a total of 2. The combined delinquency rate for the multifamily portfolio was 5.2%. And then with regard to forbearances in our multifamily portfolio, there were no new forbearance agreements in December. So from the outset of the board granting the authority the permission to or authorization to provide forbearances, we had a total of 7 projects under forbearance on encompassing 8 loans that involved just under $24 million in portfolio balance, or 1.9% of the overall portfolio. And that involved $134,000 of monthly P&I payments. Happy to answer any questions.
I was happy to see some of the proposed changes for the down payment assistance program, which I'm assuming will increase the interest in the first mortgage product. But do you see those changes as contributing to a higher delinquency rate since the borrowing amount is greater? And
that's a very good question. Our down payment assistance loans, the profile of that loan would be a higher risk, wouldn't it? Because I think it indicates 2 things. One is that the borrower doesn't have any personal equity for the most part in the loan. And then secondly, the loan was needed, which means they don't have necessarily a substantial rainy day fund in the event that they run into a financial hardship. But the easing of the amount required or the amount we allow an individual to have and still access a DAP loan increase, which doesn't necessarily mean now that the DAP borrower doesn't have additional savings in the event that there is a hardship. But they are overall a higher risk profile. But we won't see the results of that for months to come.
Sure.
Sarah, I think you're muted.
Sorry about that. So the next item is the investment and swap report with Ed Miskowski, but I had a question looking at the portfolio. Most of the swaps are still LIBOR based. And I don't want to take up a lot of time. I remember we did have a presentation from Bob Lamb, the financial advisor, about addressing those with the going away of LIBOR in the future. So maybe an update on that at a future meeting would be good. But over to Ed.
Hey, hello again. You have in your package the investment report for the 4th quarter of 2020. The investment report reflects a decrease in book value by approximately 7 million to 3.38 billion from the last quarter. The change was mainly due to three factors: bonds being issued in November, debt service being paid in November, and bonds called in December. Quarter over quarter, the weighted yield to maturity for the investment portfolio went down to 2.07% from 2.11% due to the continued decrease in short-term rates. You also have in your package a report on the authority swap portfolio. The swaps are used to hedge variable rate bonds to generate a synthetic fixed rate bond that has a lower cost to the authority than a traditional fixed rate bond. The swap report shows a hedging position of 39 swaps with 9 counterparties, totaling 930.7 million notional amount. The outstanding notional is 70 million lower than the last quarter, and the authority decreased the number of swaps by 1. The change was due to 2 swaps being terminated at par, and a new swap was added to partially hedge the previous unhedged 2014 C2 and 2020 E3 variable rate bonds. The number of swap counterparties remained the same as last quarter. The weighted pay rate by the authority went up to 3.107% from 3.079%, and the mark-to-market value increased to a negative 184.1 million from a negative 213.7 million. The weighted pay rate gives an indication of the weighted average rate the authority pays on the outstanding notional of swaps. Are there any questions?
Any questions? Okay, we'll go on to the finance audit monthly tracking report. Very long, Lambert.
Morning. This month in the multifamily area, there are no developments to talk about. In the homeownership area, we've already talked about that the loans are lower than last year. We ended up the year at 1,636 first mortgage loans and 731 DAP loans. That's about 45% of all of our first mortgage loans are using a DAP, which is higher than last year, which is directly related to some changes we made in the DAP program prior to this. And we expect that DAP percentage to go up probably a little bit more. The only thing I would have to add in the lower loans is that in our market, in our sales price limit area, although we've heard anecdotally about people moving into Connecticut, in the CHFA income limit and sales price limit area, home sales are actually down, and we track home sales through the Warren Group information, and I took a look at it prior to this meeting, and the sales are down almost in the same way that they are down at CHFA. So we are tracking pretty closely to the market. Our homeowners are in a group that may not be able to move, and the people that you're hearing about in the news who are moving to Connecticut are people who have the ability to choose where they go to. Many of our homeowners are younger people, may have either lost their jobs or have to stay home with young children. Our average age of our borrowers is 35, so these are people in a younger category with young families. So keep that in mind when you hear things in the news, that our borrowers generally in our market, sales price in Connecticut, are not increasing.
Interesting.
Any questions?
That was helpful. Thank you, Sherry, for pointing it out.
Thanks.
That's actually not surprising because, how should I put it? People with less resources don't have as many choices, if I'm making sense.
But I did still think housing prices were going up across the board, but.
It's not prices, it's more the number of houses that are being sold in CHFA's market are going down. In the much higher market, $400,000, $500,000 homes are going up. We are seeing an increase in those. But in the area where CHFA lives, and a lot of it has to do with, it's not just that people don't have choices. for the past, I don't know, 5 or 6 years, we've had a real inventory problem in that market also. There's not that many homes available to buy. So that is, the two things together are creating this sort of perfect storm.
And also the jobs being impacted tend to be more in the level of the people that we service than the higher amount. Because, you know, the CPAs of the world are working from home, as we saw, right? And government employees of the world, for the most part, there's been minimal layoffs, if any, working from home.
Yeah, can I?
Work in a factory or a restaurant or a hotel, you know, those industries, you've been impacted much more severely.
Right, and a lot of young families, a lot of people had to leave their job. They weren't laid off, but they needed to leave because their kids are now home. They had to stay home with their children, or at least one of the people had. So they may have lost half their income.
Even though the Family Leave Act changes help that, but I agree with you.
Yeah, I agree.
Go ahead.
I agree with Sherry that there's a definite inventory problem, and anything that's in the lower affordable area can get, I mean, 20, 30 multiple offers like the first day it's out. I mean, the market right now to be competitive against all cash buyers or investors, you know, it's really difficult right now for people to compete for these affordable properties.
What's accounting for the big increase in the prepayments without sort of, so do those houses that get sold, are they no longer affordable? Because you would think if there's an inventory problem, then they'd get turned over to, you know, as another, like a starter home again.
Because we're still seeing out migration in Connecticut, some of these homes are being sold, and at that point they prepay when you sell your house. In addition, people are trying to get rid of their debt because I think this has been a wake-up call for people. So it's possible, especially with the DAP prepayments, that people are trying to pay off their DAP loan first, and then they may get to the point where they want to pay off their mortgage also.
Yeah.
In addition, I think rates are just so low now that people are refinancing away from CHFA. And CHFA traditionally does not do refinances. We're a first-time home buyer shop, so that's something we want to look at. We certainly could to keep people in our portfolio, but at the moment they are leaving CHFA in big numbers.
The concern, though, is that given these sort of larger market forces, that we're underutilizing our resource at CHFA is being underutilized, right? I mean, our mortgage, and I understand it's a question about migration and inventory and low rates and all that, but our production is way down, and presumably, you know, we've upsized the bond deal, but that bond deal is going for refunding. So presumably there are resources that are idle by CHFA. And I was just wondering, Anthony or someone else, if you had any ideas on, should we be thinking, you know, with our available tools on how, given the market realities, we can start employing resources again?
I mean, I can start and Hazim can fill in, but that's exactly one of our areas of concern and discussion going into 2021. We saw a little bit of an uptick in production, especially around the DAP program changes that were made in November, but we're still not seeing production return to the levels before the pandemic. And so this is something that we are concerned about, and we're looking at various ways to restructure the program, either through different levels of compensation for lenders or rate changes, and other ways that we can make it more appealing both to the folks we do business with, but also for the ultimate borrower at the other end.
Improve incentives to originators, maybe, or just more heavy level of subsidy because just rates are lower. So our program, or more generous DAP terms. I don't know.
Yeah, no, that's you're right on point there. So, yeah.
Yeah, it comes down to trying to increase the purchasing power of our end user.
Right.
Some people go ahead. I'm sorry. I can't find my hand.
you indicated that we don't do refinance. I mean, is that something we should be seriously looking at? I mean, given where we are right now, even or is that just not doesn't make sense for CHFA?
I think that's a little bit of a policy discussion, perhaps with the board. I've discussed it a little bit with Hazim, and I think it comes down to kind of how we see ourselves, right? It's if we see ourselves as enabling first-time home buyers to become homeowners, is that our mission, or is it our mission to provide the lowest cost of financing, and when it's available, be there to with the resources? So I think I don't think it's a no. I think it's something that we kind of need to look at and understand under what circumstances we might allow refinances, and for what reason. How does it fulfill our mission? How does it enable us to do more? And that's an open question, but one that I think is worth looking at and answering.
Yeah, I think that's fair, and I think we should at least discuss it, right? I mean, because I could make an argument that if we're trying to help, families build wealth, look, being able to refinance and save, a few $100s a month could help people move from point A to point B. But I'd love to hear the other side of the argument as well. I'm not, obviously wedded to that.
Yeah. I
Well,
think
if you want to hear the other side of the argument, that's what I was going to make. I would like to remind people that government's role is not to compete with the private sector, at the risk of being called Republican, which I'm not. And I mean, this is actually good and bad news, right? It's bad news because we're not helping as many people, right? And the numbers are lower. But the good news is the system is working, right? People have choices, and they're making those choices. And maybe the focus should be that if you have a lower income, maybe that's more subsidy. Maybe the rate is a little better, right? So we could facilitate those lower level people to accumulate access faster, which the private sector will not accommodate. But I mean, I remind people that the role of government is not to compete with the private sector, right? It's to be an alternative or to try to achieve a goal, a public goal. But if that's being achieved in the private sector, it's really a function to hinder it, And I'm not saying there's a right or wrong answer, right? What was that?
Yeah, no, I completely agree with you. I just think it'd be useful to have the discussion
Well, no,
amongst
that's what we're
the
doing.
board.
Discussions are good. Yeah, no, the discussion is good. I mean, and like you say, you were looking forward to the other side of the argument, and that's what I'm doing.
But if mortgages are
Former
available, if mortgages are available to what was originally our target market in single family homes, my point is exactly that. We should be thinking about the resources available to us and do it to address all those people, George, that you basically, kind of articulated before, who are much more stressed in this economic environment, are going to be much more stressed as things go back to normal because of long-term trends of economic inequality. And that's really where, I mean, as we have this discussion, where I would like to see us rethink about chief mission, because there are lots of people who are not being served, by the market. And that's, I think, what we have a duty consistent with our statutory basis to try to address.
Jerry, you said it more eloquently than I did. And my point was that instead of doing a broad policy, that we start incentivizing realtors for any type of loan, right? Or any type of level of income, that we may focus our direction to really try to help those who might otherwise still become a homeowner, but struggle more than they should have, right?
Exactly.
Increase the chances for those who are in the margins to be more successful, right? To be more likely to do increase assets, right? Versus if you do, if you start giving brokers or whoever, realtors, I mean, I'll be using the right name, right?
I think lenders,
incentives, you're going to get what you're paying for, right? Because people get motivated by bonuses. Not everybody does things because it's the right thing to do. And I'm not saying that that's the wrong thing to do, Versus targeting who you really want to help, right?
I just
think-
like to echo what Tim said, which is anytime we can look at anything through the lens of creating wealth and generational wealth, I think we have an obligation to do that right now. So just with any of the discussions on, I think from any of us involved in the housing industry, I think that is really the most important thing that we can do to serve people right now.
I think it would be interesting to look at the reason for all of those prepayments. I mean, if it's people who really can't afford their houses and are selling to get out and to potentially leave the state, I mean, you know, there may be an opportunity to retain some of those customers too.
But also,
Yeah.
I mean, the rates are so low. I mean, the rates are like 2-3 weeks ago, what, 2.85?
This is the first appreciation our state has had in like 12 years. So some people are selling just because this is the first chance they've had to make a profit on their investment. So, I mean, there's a whole group of people that are just like trying to get out from being underwater, you know, that this is what's going to allow them to recover some of that money. So I think you're right. There's all sorts of forces that are happening right now with all of these things that are happening.
Well, obviously a bigger discussion. I just want to throw in the thought that these prepayments may actually impact the capacity of CHFA to provide new loans, you know, to the extent they're hurting our cash flows. It might be in our self-interest as well to allow refinancing. But let's, in the interest of time, move on to our internal audit report with Joyce Campy.
Good morning. Gosh, that's a tough conversation to follow. But I'll just try to make some quick points. So before you is the internal audit report. The first memo in your package provides you with an update on the audit activity since October. In terms of CHFA audits, we completed a follow-up audit of the LIHTC allocation process. That is considered a high-risk audit, and the original audit was completed in 2019. The audit results indicated that the majority of the audit recommendations have been addressed. We also completed an audit of the monitoring of Mule, which subservices about approximately 20% of the single-family mortgage loans, whole loans. As you may recall, we did a servicer compliance review of Mule in 2019. So the focus of this audit was to look at the processes here at the authority, which were unique to the subservicing relationship. Audit recommendations are being implemented by management. The detailed audit reports for both of these reviews are included in your package. Turning to servicer compliance reviews, we completed 2 desk reviews of two servicers, Santander and Berkshire Banks. That represents about 5.5% of the single family whole loans. Servicer review conditions, action plans, and recommended follow-up were discussed with management. In terms of consulting activities at the request of management, we also provided a staff member to assist with the TRAP program. Towards the end of your package, you'll find a second memo, which is a discussion of our 2021 internal audit plan. Similar to prior years, the audit coverage represents a combination of CHFA audits, servicer compliance reviews, and planned consulting activities. During the planning process, we meet with management to obtain their input, and we review the plan with them to ensure that our coverage aligns with the authority's goals and risks. So audits, in terms of CHFA audits, we have included in the plan certain higher risk business functions. Starting with administration, we'll be performing a review of the contract review and approval process, which also includes competitive bidding. We also have planned a review of IT physical and logical security, as cybersecurity is a growing risk factor. On the multifamily side, we continue to focus on tax credits. The allocation portion of the Housing Tax Credit Contribution, or HTCC program, was reviewed in 2020. We will be reviewing compliance monitoring for this program in 2021. The timing of our review is contingent upon management's implementation of a new process. Switching to the single family side, we will be reviewing controls over EMAP, which is the Emergency Assistance Mortgage Assistance Program, and performing a follow-up of single family mortgage insurance claims. We selected these two areas for review in anticipation of increased volume due to the economic impact of COVID-19. For servicer reviews, we've selected on a cyclical basis, basically 3 servicers for review. They represent approximately 15% of the single family whole loan portfolio. Those servicers are Norcom Mortgage, Webster Bank, and People's United. And lastly, in terms of consulting activities, we've been asked to participate on strategic plan goal number 7 related to process improvements. And with that, I'd be happy to open it up to any questions.
Any questions for Joyce? Our next item is the minutes of the Finance and Audit Committee meeting. I think this is an action item. Do I have a motion to approve?
Moved, Tim.
Second? Second, anyone?
Kathy, second Kathy.
And then any discussion? And I guess do we need a roll call on this, Amy?
We do. Sherry Abrahams,
Aye.
Tim Hodges,
Aye.
Kathy McKinnon,
Aye.
George Perez,
Yes.
Franklin Perry,
Aye.
Sarah Sanders,
Aye.
Gwendolyn Thames.
Yes.
Okay.
Sarah?
Yes.
Before we end the meeting, I just want to inform the committee that Ed Mikowski is retiring, and this is his last meeting. I would like to take this opportunity to thank him for his 24 years of service and the assistance and support he provided me ever since I joined CHFA back in the late 2013. I also like the committee to know how appreciative we are of him and how valuable his contribution was to the finance department and to the authority as a whole. Ed, it's been a pleasure and you'll be missed.
Thanks, Ed.
Oh, thank you. It's been my
Thank you, Ed.
pleasure serving what I could do. Thank you.
I would just also like to say thank you, Ed, because I came to the treasurer's office 23 years ago, and I've dealt with Ed. He's been Mr. CHFA to me for all those years, and I've really enjoyed working with you. Interfacing on the bonding side, and I always think of you as that a kid, to be honest. So I can't believe you're retiring, but anyway, good luck to you.
Oh, thank you. It's been my pleasure.
Okay, motion to adjourn. All in favor?
Aye.
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 The other side.
Thank you.
Thanks.